As we kick off the new year, we want to share a quick look at what actually mattered in the markets last year, and more importantly, how that shaped the way we build and manage portfolios. This isn't a headline recap, it's the bigger picture. 2025 wasn't about predicting the market, it was about whether portfolios were built to handle a mix of high rates, cooling inflation, uneven growth, and very concentrated market leadership, all at the same time. Rates shifted from rapid hikes to gradual easing, inflation kept cooling, not perfectly, but meaningfully, growth held up better than expected, and a relatively small group of large companies drove a big share of the market's returns. It wasn't a clean risk-on, risk-off environment, it was a little bit of everything all at once. That's why portfolio construction mattered more than any single prediction. Here's what made the difference. Growth stayed resilient, even as hiring cooled, consumers kept spending, and earnings held up. Inflation continued to cool, reducing pressure on both consumers and the Fed. Interest rates continued easing, which helped both stocks and bonds. AI productivity showed up in earnings, not just excitement, and staying invested paid off, even during big headlines like the April tariff announcement when markets dropped sharply and later recovered. This year was a year where patience and discipline were rewarded. 1. Bonds are useful again, but differently. In 2022, stocks and bonds fell together, and that was the outlier. Today, yields are higher, bonds are generating real income again, and they're providing stability, especially in the middle part of the yield curve. They're not a silver bullet, but they are working again as part of a balanced strategy. And number 2, concentration risk is the new risk. AI has been powerful, and intentionally or not, most investors own some of it, but we don't want portfolios tied to one story. So our approach blends growth with other styles, global exposure, income strategies, and true diversifiers. The goal isn't to avoid growth, it's to avoid depending on any single outcome. Most importantly, our portfolios behaved the way they were designed to. They participated when markets moved higher, and during periods of volatility, they stayed within the risk ranges we planned for. That's important because staying within expectations helps investors stay invested. And staying invested is what drives long-term success. Looking ahead, we're optimistic but selective. We want exposure to AI, but not dependence on it. We see opportunities internationally where valuations are more reasonable, and income now comes from multiple places. Bonds, dividend strategies, and diversified approaches that don't rely on interest rates moving in one direction. No big bets, just thoughtful adjustments. This isn't about predicting the next headline. It's about knowing portfolios are built to handle a wide range of outcomes, so investors can stay confident and stay focused on the bigger picture of their financial lives. As always, thanks for watching. We look forward to connecting with you soon.